split banking is when you use multiple banks or a second bank rather than having everything at one bank. So for example, let's say you've got your own home mortgage at BNZ. For your investment property, you might take your deposit from BNZ if you're borrowing that, and then you might go to Kiwibank, for example, for the second mortgage. Split banking's become more common in the last few years, and in the past, it would be fair to say that 15 years ago, people would tend to just use their own bank for everything. So a couple of reasons why split banking is so important nowadays is because banks will reassess your ability to service your loan both at application time and at sale time. So for example, if you've got all your eggs in one basket and all your loans are at one particular bank, if you sell an investment property and intend to use the sale proceeds to start a business or go on holiday, the bank's going to look at your serviceability again. Now, if, for example, you've quit your job to start that business, they might say, we're not going to let you have the profit from that. You need to pay down debt with that money. So you lose a lot of control there. One of the other reasons that people like using split banks is to protect other assets. So for example, let's say your own home again has a mortgage with BNZ. If you then go to BNZ to buy an investment property, both properties are linked in together as securities for both loans. Now, in the event where the bank wanted to sell a property, i.e. a mortgagee sale, the bank can take either property and sell them or both. Whereas with split banking, maybe your investment property is with Kiwibank, for example, so they can only sell the investment property if your own home is somewhere else and protected by something like a trust. Let me give you an example of some investors who didn't use split banking where things went wrong. So in this case, a client who I know had their own house and their investment properties all linked with one bank, and they had 4 rental properties. Now, they downsized their owner-occupied house because they'd retired and they wanted to live on some of the money that they make from downsizing, and they made $200,000 cash. Now, what happened is the bank reassessed their servicing, and because they'd retired, they no longer had an income to help service their investment portfolio. So what the bank did was they took the $200,000 profit that they'd made, plus they reduced their credit card limits, they took away their revolving credit, and they took the savings from their own accounts and paid down investment debts. And what it meant was the investors had to then sell rental properties to actually get that money from their own house out to live on. Now, the sad part about this story is that this all happened right before Christmas, so it was incredibly stressful for the people who just thought they could take their money and use it for whatever they liked. And the other thing is, although the bank servicing didn't work, those properties were paying for themselves, so they could have afforded to own them for a number of years longer, but now they're forced to sell them and miss out on all that future potential capital growth. As you grow a portfolio, the more properties you own, often the less the banks will lend against your overall portfolio. So by using split bank, you can maintain 80% LVR on investment properties as opposed to, say, a reduced amount of 70%. So how does all this work? Now, again, not to favour BNZ, if you have your own mortgage at BNZ and you're paying that down diligently and you want to buy an investment property, what you do is you or your broker apply for, say, $100,000 as your deposit for an investment property. So you have a secondary mortgage away from your owner-occupied mortgage of $100,000. That becomes your deposit for a new bank. So then you go to Kiwibank, as I used in the example before, and you ask for 80% against the new investment property. So what that means is your home and your mortgage stays with BNZ. You have an additional loan of $100,000, which is your deposit loan for your investment property. Your investment property is secured with Kiwibank and secures the 80% loan that you have there. So in this instance, you've borrowed 100%, $400,000 and $100,000, buying a $500,000 investment property, but you've borrowed 20% from your bank and 80% from a second bank. Sometimes people can feel a little bit coy about cheating on their bank using two banks. And remember, actually, you've got to do what's right for you. So if you've got a good relationship with your personal banker, it's okay to use a mortgage broker to facilitate this and explain that the reason you're doing this is protect your assets. So there's nothing wrong with using split banks. There's nothing wrong with using multiple banks.